Hey everyone, welcome back to the channel. I'm Doug, the retirement guy with the monthly ETFs. Planning for early retirement living off of dividends? We're continuing our series as part number 3, the 3-bucket monthly ETFs income system. The reason why we have this one is one ETF is too risky and a system is much smarter. Most investors who choose to chase monthly income make the same mistake. They pick one high yield ETF and hope it's going to do everything: income, stability, growth, risk control. It's basically everything in one package, and that almost never works. So today we're going to show you a 3-bucket monthly income system designed for separate roles and to manage the risk and create more durable income over time. Now, this is not going to be a list of recommendations. This is more of a framework that you can use to evaluate any monthly ETF. Guys, so important notice to everybody, this presentation was designed and provided to you by an educational purposes only and is not constituted financial advice. Educational purpose, no financial advice. Distributions are not guaranteed. The yields are subject to change without notice. And if you need any professional help, if you need questions on the financial stuff, always contact a financial professional. Don't just watch a YouTube video. Don't just ask someone who sounds like they're intelligent with it. Always ask a professional first. So building a 3-bucket monthly ETF system does this. It gives you safe, balance, and aggressiveness. We put them into tiers. Tier A for stability, Tier B for balance, and Tier C for aggressiveness. So in Tier A's, we're looking for lower risk and smoother income. In the B's, we're going to look for the balance of the yield and sustainability. And Tier 3 is going to be that high yield, high risk funds, because the 3 working together is stronger than a one ETF risk as a simple system. So why a system beats a single ETF? Well, monthly ETFs are powerful tools, but each one is built with trade-offs. Some prioritize stability, some maximize the income, and some take aggressive risks to boost their yield. Trying to force one fund to do all 3 usually leads to NAV erosion, income volatility, and poor long-term results. A bucket system solves this by assigning specific jobs to different parts of the portfolio. Think of it as a pension manager, not a yield chaser. So the problem with a single ETF strategies, most investors rely on one high yield ETF, expect multiple different benefits from simultaneously from that one fund. They want income, they want stability, they want growth, and they want that risk control. One of the funds that a lot of people turn to, and you'll see a ton on the marketplace talking about this one, and that's going to be the Charles Schwab SCHD. Now, this has been one that's gone on for years and years and years. And, when we sit down with it, we say, does it have income? Yeah, it has income, about 3.5% dividend yield per year. Has it been stable? Sure, it's growing its dividends each and every year. And the fund has given it growth. Is it risk control? It is. But can you actually live off of the Charles Schwab SCHD for a long period of time? Well, you can if you have a huge portfolio, if you have a huge amount of money poured into the fund to generate that kind of money. So the 3-bucket system overview, the system uses what we call 3 income buckets. And as I said before, Tier A is for stability bucket. Tier B is the income optimization bucket, and Tier C is the high risk income bucket. Each bucket has a defined purpose and its defined risk profile and defined role in the monthly cash flow. No bucket replaces another. They all work together. When we take a look at Tier A, you're looking to protect your capital and smooth out your income. It's a foundation of the system. It's going to be lower risk and more stability. Now, Tier B are going to be more income. It's a balanced income and sustainability, and mid to high distribution rates. Remember, we're not going to be chasing yields on this stuff. You don't chase yields when you're building a system of the buckets. And then the high risk is going to boost our cash flow. It's going to give us a high distribution rates, and it's going to be higher risk and higher volatility. But we're going to be able to handle that using the other two buckets. So let's break down each tier a little more detailed so you can understand why each bucket is built for what it's built for. We're going to start with Tier A. It's the stability bucket and the foundation. The role of this is to protect your capital and smooth out your income. What this bucket is designed to do is reduce your volatility, provide predictable monthly cash flow, and acts as a foundation of the system. Okay, so what we're really trying to find is the secure ones. And when we say foundation, this is the one that are going to give us what we really expect to help the other two buckets fluctuate through rougher times. Now, the characteristics and the expectations of Tier A is we're going to be looking for things that are lower distribution rates. They're going to have stronger NAV discipline and more conservative option overlays or dividend sources. What we're not looking for is maximizing yield. We're not going to go out and search for the biggest yield possible and put it in here because that's not what we need in Tier A. We're not going to have the aggressive upside. We're not going to have some exciting headlines that this is the hottest new ETF that's out there. You need to have it in your portfolio. That's not really what we're always looking for. What we want to find is that steady, stable distribution, the steady and stable NAV, which is the net asset value. Okay? We don't want to see a NAV going up, down, every which way. And we're going to want more conservative options. We want a strategy that's probably either A, focused on more company dividends versus option trading to get the dividends. So we're just kind of giving it more what I call a secure type application. The bucket exists so the rest of the system doesn't have to be perfect. If the markets turn volatile, Tier A is what keeps the income flowing while slightly riskier strategies are reset. So let me show you here in Tier A some ETF examples that we talk about. The stability-focused ETFs are the foundation of your income strategy. The very first fund that we talk about is going to be PFF, and that's going to be in shares preferred income securities. This focuses on preferred shares for the higher yield and more stability than aggressive income strategies, and provides regular income with a low volatility. Now we look at total return, 6.73. The yield is 6.13. So you can see majority of the total return is coming from the yield. That's income. The next one we turn to, LQD, is iShares Broad U.S. Investment grade corporate bonds. Okay, broad corporate bond ETFs with monthly distribution generates less volatility than equity orientated income funds. You look at the total return, 8.64%. The yield, 4.47. So about 50% of it's coming for income, while the other part is coming for growth. And then the final one is the Invesco S&P 500 Low Volatility ETF. While not exclusively a monthly payout fund, it emphasizes on low volatility stocks for smoother performance and pays monthly dividends. Total return 7.12. The yield's only about 1.99. But again, that's giving us about a 5% growth in a fund. Okay? So this is, again, We're building fun with income. Now, the Tier A exists so that the rest of the system doesn't have to be perfect. Now, again, these are not recommendations. These are just pieces that I pulled and put into a system to show you, and you can do some research on each one of these to get a better feel of what each and every one of the ETFs in Tier A would look like. Now let's break into Tier B, the income optimization bucket. Now, the role of this one is the balanced income and sustainability. This is where most ETF investors should spend the time evaluating the funds that they're going to put into it. And this is the one you want to keep the eye on. Now, what this bucket is designed to do, it is really to generate higher income than Tier A, but still maintain a reasonable total return using an option premiums effectively. Okay, so we're looking for higher income, but we still want that sustainability. We still would like to have that income on a regular basis and able to have some growth coming out of it. So generating that higher income than Tier A and maintaining that total return is what our real option is. Now, the characteristics and what we're looking for in the Tier B is we want mid to high distribution rates. Okay, we want active or rule-based option strategies, and we want income that adapts to volatility. So Tier B is not going to, again, be chasing the highest yields. It's different, and it's more about effective income per unit of the risk. We're going to be looking at things that are balanced. Higher income than Tier A, reasonable total returns, and strategic risk allocations. The strategy is active option overlays, rule-based approach, and volatile adaptation. And efficiency, income per unit of risk. So the higher the risk, we want more income. The lower the risk, we understand we'll take lower chances. So suitable distribution rates and long-term optimization. This is something that we want to look, almost like you've always heard this. You want to set and hold, set it, forget it. These are the ones that we're kind of putting in the Tier B that we want to set and forget it and let it go because it's going to be a long time. But again, remember, we do not chase the highest yield. We want the best total package. So in the ETFs example I'm going to show you, these are three funds that are designed for income optimization. The first one, JEPQ. Total return 15.80%. You can already see the returns are much higher than we had in Tier A. Yield 10.39. Now this is a great one here because when you look at the total return versus the yield, you're looking at almost about a 5% gain or growth in the fund and 10% coming to you as income. Now I want to say up front, all of these numbers will change on a regular basis. They'll change as the stock market opened up, they start to change. Yield changes by the price of the funds. So using these are just examples again. The next one, SPYI, the NEOS S&P 500 High Income ETF. Now this one has a total return of 16.61%. Again, the yield 11.57. Magical number, about 5% growth, and the rest goes into income. And then our final one is the Amplified CWP Enhanced Dividend, we call DIVO, D-I-V-O. Total return 18.07. Now the yield is lighter at 6.27, and you may turn and say, well, why was that one? 12% going more towards the growth. Again, inside of a bucket, each fund works with each other to help cover any type of recovery that may need to be happening. Now we're going to get into Tier C, which is probably the bucket that most people originally thought this is what we're going to do. And the thing here is, this is the high risk income bucket. This is going to boost cash flow, knowingly and intentionally. This is where many investors get into trouble because they treat Tier C funds like the core holdings. They are not. Okay? These are funds we may change out 3-4 times a year. But these are funds that are in the market to help us for a particular reason. What's in bucket is designed to do is generate very high income, explicit volatility, and concentrate strategies. They enhance the total system's cash flow. Okay? These things are designed to have that big volatility. We're expecting these to have ups and downs in a month. Okay? And we're not going to freak out because the other two buckets are help covering and smoothing out the road. But remember, these are not buy and forget funds. You have to actively monitor these type of funds. Now we get to the risk side of it and the characteristics of it. Very high distribution rates. Okay? They're going to elevate your NAV risk, and they're going to be more aggressive option and leveraged type funds. Okay? C's only work when it's sized correctly. So this bucket is optional. You do not have to put this into this bucket. But this bucket is also technical. That we're moving forward to create that bigger income. And that actively monitoring is keeping an eye onto it. Once you see a fund start to drop off, you have an exit plan on each and every fund so you can walk away. And you need to have proper position and sizing. Okay, very high distribution rates, elevated NAV risk, but sized correctly within the total portfolio, and regular review and rebalancing. This is very easy to do and very safe in this type of a system. Let me show you some of the things that go on. Tier C, the ETF examples. QQQI. Now this one here gets rated be the high yield because it's cranking up 13.69% yield for a total return of 18.39. Now this one banks off the NASDAQ 100 covered call. It's heavily focused on tech side of it. So if the tech has a poor week, poor month, or anything happens in that tech and AI section, this one's going to have the potential of that NAV downside. Now we go into Bitcoin, BAGY. This is a crypto volatility. And if you look at it, go back and do some research on this, which we highly recommend you do your own research. That is, you go back and look at what crypto's done since October. Crypto has had a big, massive fall off. And it does it about every 4 years. So the risk level is higher. The yield potential is definitely higher. But crypto has a volatility play. Look at the yield, 33.47 over the past 12 months. Your total return, though, is only 0.18. That means the fund has lost over 33%. And then we go to another fund, EGGY, EGGY. This is a dynamic income strategy with adaptive approach. This one has a total return of 16.71 with a yield of 28.06%. So if you tally these up, you're going to have a big yield. But when you take a look at total return and add them together, well, you got BAGY pulling the thing down, but the other two pulling it up. But in this segment, you would turn around and say, whoa, my NAV is going up, my NAV is going down all over the place. But when you put it into the bucket system, you smooth out that entire road. So why does the bucket system work? And here's the insight. You don't need every ETF to be perfect. You need the system to work. You need tier A's for that stabilization of the income. You need tier B to optimize your returns. You need tier C to enhance your cash flow. When one bucket struggles, the others absorb the shock. That's how institutions think, and that's how income ultimately lasts. Now, some of the common mistakes to avoid, and mistake number one, and I know this is going to happen with a lot of people, I've seen it personally happen, is they put everything into tier C. I want those big incomes. I want that big, massive paycheck. And guess what? They're losing money as they're going through. They have a lot more risk going on. And they ignore the bucket system. Mistake number two, expect tier A to deliver high yields. So they will pull funds out that are saying, I'm only getting a 5%, 6%, 3%. They'll rip those out and put in a 10, 12%. They'll take something from point B and put it into A. And again, they're missing the mark. Mistake number three, ignoring total return and focusing only on monthly payouts. Mistake number three is probably one of the biggest mistakes that are in ETF trading and ETF marketing and investing across the board. Everyone always looks at high yields, and we call that yield chasing. They're looking at the biggest yields. What's the biggest yield? What's my payout all the way through? And they ignore the total return, because the total return is your true number. At the end of the game, you may have, and I showed you a few funds in here, you may have a 28 or a 30% yield, and you barely have a total return. That means the money that you got back was not anything gained, nothing earned. It came from the fund, virtually your own funds coming back to you. Mistake number four is never reevaluating your bucket's weights and make changes. That basically, you set up the bucket, you did all the work, you got it all done, and guess what you did? You never monitored it, you never rebalanced it, you never changed anything. And this is not something that you're going to do. The way I explained it to my kids was this. How often do you look at your car insurance? You get a car insurance bill every 6 months. How often do you reprice your car insurance, or do you just pay the bill? And if you go 2, 3, 4 years of just paying the bill, how do you know that that's the best price of car insurance? So I always tell everybody, every 6 months, reevaluate your car insurance. Shop it around and find out, do I have the best price? Do I have the best coverage? Do I have everything that I need? And every 6 months, you just take care of that. Same thing with this fund. You reevaluate it. Now, the framework and scalability and the future applications of a three-bucket system. Expanding the three-bucket system for broader applications. In the future videos, we can always break down real ETFs into each bucket. Because what you want to do is you want to evaluate your ETF's evaluation and figure out which bucket does it actually fit into. So you have a better idea of, I want to put help with my A bucket, or I want to help with my C bucket, or I want to help with my B bucket. And it's easier to evaluate each and every one of these. You want to assess the risk profile and the income characteristics and determine the optimal bucket placement. Now, we want to do some stress testing. You want to test the system in different market environments. Evaluate the bucket performance during volatility. And asset the NAV resilience across scenarios. And the adaptive application. Compare buckets combinations for different goals. Show income shifts over time and adapt the framework to investor needs. So this whole thing is adjustable to fit each and everyone's needs and requirements. But you have to understand how the system works first, what it's used for, and then put the pieces of the puzzle together. In all my years of business, I always said this: you need to put the right people on the bus. Then you need to put the right people in the right seat on the bus to have a great bus ride. And that's what we're doing here. We don't want a C inside an A. We don't want an A inside of a C. We don't want a B floating all over the place. We need to evaluate each fund properly and insert it in accordingly. So in closing, and the key takeaways, I'm going to give you this. The system wins when used properly, and it wins when you're relying on the system versus a single ETF. The bucket system, using the A for stability, B for balance, and C for aggressiveness, is the key factors of what's going on. And regular reviewing and reevaluating your bucket, it sounds like that's a lot of work, but actually, for most people, actually becomes kind of a fun little thing to do. And you don't have to always be listening to the hype, but you'll be listening to the hype and saying, where would this one fit? Maybe this is a C, maybe this is a B. Because most people won't talk about the A's. We do here on the channel because we're worried about people in retirement. Now that brings me to the next point, that this video is for educational purposes only. There is no financial advice. The funds I showed you, they're not recommendations. They are just examples to use to show you how, in the educational purposes, of how they would fit. There are no guarantees. I am not a personal financial advisor. If you don't know my story, I started studying retirement at the age of 27, and I retired early. I've been retired for over 10 years, living off of dividends. So I give you this, one ETF is extremely risky. A system is much smarter. And when I say one ETF, I'm not just talking about one fund. I'm talking about one tier of C's, one tier of B's, one tier of A's. Is a system is smarter. You need the combination of all three. Guys, let me know what you think of it. We're continuing on with the series because it seems like you guys have really liked it. Leave us a comment down below if you have any questions or any input of what we showed you today. We appreciate it. We thank you. And if you're not a subscriber, hit the subscribe button. And down in the links, I'll tell you right now, in the comment links, I'm going to post and pin each one of the videos so you guys can see the series from the beginning all the way up to version number 3. Thanks, and we'll catch you next time. Guys, so important notice to everybody, this presentation was designed and provided to you by an educational purposes only and is not constituted financial advice. Educational purpose, no financial advice. Distributions are not guaranteed. The yields are subject to change without notice. And if you need any professional help, if you need questions on the financial stuff, always contact a financial professional. Don't just watch a YouTube video. Don't just ask someone who sounds like they're intelligent with it. Always ask a professional first.